The financial markets, with their ceaseless movements and dizzying potential for profit, often entice individuals with the promise of a single grand stroke of fortune. Many are drawn to the arena of speculation with the hope of making one large, perfectly timed trade that will instantly transform their financial standing. However, the harsh reality is that most traders, driven by impulse and a lack of systematic approach, enter positions haphazardly, committing too much capital too soon, and exposing themselves to unnecessary risks. This undisciplined approach invariably leads to frustration, losses, and ultimately, a premature exit from the market. Subscribe now, leave a like, and write any comment. This way, you'll help more people see and hear this message, and I'll know that my work is not in vain. What separates the enduringly successful speculator from the fleeting casualties is not a mystical ability to predict the future, but a profound understanding of process and discipline. The legendary Jesse Livermore, a figure who amassed and lost immense fortunes multiple times, perfected the art of building a position methodically, rather than attempting to execute a single, all-in transaction. He understood that true profit on the exchanges stems not from a singular entry point, but from the careful, step-by-step construction and management of a trade, reducing risk while maximizing potential gain. Livermore's approach to speculation was rooted in patience, observation, and meticulous execution. He recognized that the market rarely offers clear, unambiguous signals that warrant an all-in commitment from the outset. Instead, it provides subtle confirmations that, when recognized and acted upon with discipline, allow a speculator to gradually build a powerful position, escalating their commitment only as the market validates their initial thesis. This systematic approach eliminated much of the emotional guesswork and reckless abandon that plagues the average trader. Many aspiring participants, eager to capture every perceived opportunity, fail to appreciate the wisdom of this measured approach. They rush into positions, overcommitting capital prematurely, and then find themselves psychologically vulnerable to every minor market fluctuation. Livermore's method, however, championed a contrarian view, that the highest profits were made not by rushing in, but by waiting for opportune confirmations and scaling into a trade with a clear, predetermined plan. Therefore, this exploration will dissect the precise, step-by-step methodology Jesse Livermore employed to build a trade the right way. It is a journey into the mind of a master who understood that sustained success in speculation is a consequence of disciplined process, not impulsive action. Embracing this methodical approach to position building is paramount for safeguarding capital, controlling emotions, and ultimately, maximizing profits in the unpredictable arena of the financial markets. The very first and arguably most crucial step in Jesse Livermore's method of building a trade the right way was to initiate a small, probing bet, never committing his full intended capital at the outset, regardless of his conviction. He understood that even the most meticulous analysis could be flawed, or unforeseen market forces could quickly negate an initial thesis. This initial, cautious entry served as his market reconnaissance, a low-risk test to confirm if the market was truly behaving as his analysis suggested. The primary purpose of this probing bet was to verify the accuracy of his preliminary assessment regarding the line of least resistance for a particular stock or commodity. He would buy or sell a small initial quantity, observing the market's immediate reaction. Did the price move as expected, indicating a clear path of least resistance in his favor? Or did it hesitate, falter, or even reverse, signaling that his initial read was incorrect or premature? This small position acted as a barometer, providing crucial, real-time feedback without exposing a significant portion of his capital. This deliberate caution also served a vital psychological function. By initiating with a small amount, Livermore maintained strict emotional control. If the probing bet immediately moved against him, the financial loss was negligible, allowing him to cut the trade swiftly and without emotional distress. This minimized the impact of being wrong, preventing a minor misjudgment from escalating into a significant, emotionally draining loss that could cloud future decision-making. It was a testament to his understanding that capital preservation begins with prudent, initial risk management. Many traders, driven by greed or the fear of missing out, often jump into positions with their entire intended stake from the very beginning. This all-in approach amplifies emotional reactions to every price fluctuation and makes it exceedingly difficult to cut losses if the trade immediately turns sour. Livermore, however, understood that the initial capital deployed was merely a test of the waters, an invitation to the market to confirm its direction, rather than a definitive declaration of belief. Therefore, the first testament in building a trade the right way is to always begin with a small, probing bet. It is a disciplined act of humility, acknowledging the market's ultimate sovereignty and your own fallibility. This methodical first step ensures that your initial risk is minimal, your emotions remain in check, and the market itself provides the crucial confirmation needed before committing larger amounts of capital. setting the stage for a truly robust and well-constructed position. Once the initial probing bet confirmed the market's intended direction, Jesse Livermore advanced to step 2, adding to the position only at key points of confirmation. This was the core of his pyramiding strategy, a disciplined method of scaling into a winning trade, fundamentally distinct from the dangerous practice of averaging down on losses. He only increased his commitment when the market definitively validated his initial judgment, proving that its line of least resistance was indeed moving in his favor. Livermore defined key points as specific price levels where a stock or commodity, having moved past an initial resistance or support, would clearly indicate a continuation of its trend. These were not arbitrary prices but moments when the market, through its price action and volume, unmistakably confirmed that its path of least resistance had shifted. He viewed these as junctures where the market was signaling its next decisive move, providing a low-risk, high-confirmation opportunity to add to a winning position. His method of adding to a position was a classic example of pyramiding on the right side. This meant that he would buy more, or sell more, if shorting, only as the price moved in his favor, past a crucial confirmation point. Each subsequent purchase would be at a higher, or lower, if shorting, price than the previous one, ensuring that he was only increasing his exposure to a trade that was already profitable and validating his thesis. This stands in stark contrast to averaging down, where a speculator adds to a losing position, desperately hoping for a reversal. Livermore understood that large fortunes were not made by picking exact bottoms or tops, but by patiently and methodically riding major trends. Adding at key points allowed him to expand his exposure as the trend gained momentum, transforming an initial probing bet into a substantial position. This disciplined scaling ensured that his capital was deployed effectively, multiplying his potential profits only when the market itself confirmed the wisdom of his actions. Therefore, the second, vital step in building a trade the right way is the methodical process of adding to your position only at key points of market confirmation. This requires immense patience, rigorous discipline, and a profound understanding of price action. By pyramiding on the right side, you are aligning your capital with the market's validated direction, transforming small initial gains into potentially immense profits as the trend unfolds, minimizing risk while maximizing the potential for significant accumulation. Subscribe now, leave a like, and write any comment. This way, you'll help more people see and hear this message, and I'll know that my work is not in vain. Once a position was established and Livermore had begun to scale into it via key points, his focus shifted to step 3, continuously managing risk within the position and protecting every earned profit. He understood that the preservation of capital was paramount, not just at the entry, but throughout the entire life of the trade. The mistake of allowing a profitable position to turn into a loss, simply due to a lack of vigilance or emotional attachment, was a cardinal sin in his speculative philosophy. A crucial aspect of this continuous risk management was the relentless adjustment of his stop-loss orders. As a profitable trade moved in his favor, Livermore would systematically raise his stop-loss level, often trailing it behind the advancing price. This ensured that even if the market suddenly reversed, his previously earned paper profits would be locked in, or his initial capital would be protected. He never permitted a significant winning position to regress into a losing one, viewing such an occurrence as an unforgivable act of emotional negligence. Livermore also observed the behavior of the market during minor corrections or pullbacks within an established trend. He used these retracements to assess the underlying strength of the movement, but never, under any circumstance, would he add to a position that was moving against him during such a pullback. While others might see these as buy-the-dip opportunities, Livermore understood that adding to weakness, even within a trend, was a deviation from pyramiding on the right side and carried unnecessary risk. Psychologically, protecting the gain also meant resisting the common human tendency to let greed dictate the exit. Many traders, having accumulated substantial paper profits, become so fixated on capturing the very last fractional movement of a trend that they neglect to protect their substantial gains. Livermore understood the folly of this. He was willing to give back a portion of his profits from the absolute peak to ensure that the bulk of his gains were secured, refusing to allow a big fish to escape with the entire catch due to his own imprudence. Therefore, Step 3 in building a trade the right way is a dynamic and continuous process of vigilant risk management. It requires unwavering discipline to protect profits, to systematically adjust stop losses, and to never let a winning trade turn into a losing one. This continuous defensive posture ensures that the capital gained from successful speculation is preserved, allowing the speculator to remain in the game and capitalize on future opportunities, rather than seeing hard-won profits evaporate due to carelessness or emotional attachment. The final and equally critical step in building a trade the right way, as practiced by Jesse Livermore, was Step 4, systematically unloading the position when the market changes character. He famously stated that he never attempted to sell at the exact top or buy at the precise bottom, recognizing that such perfection was impossible and a pursuit of fools. His objective was not to capture every single point of a move, but to capture the substantial middle portion, exiting gracefully and methodically when the market's underlying strength began to wane. Livermore paid meticulous attention to the subtle signs of a change in market character. These were not abrupt reversals, but often a process marked by specific behaviors, the market making new highs on significantly reduced volume, indicating a lack of conviction, increased volatility without corresponding net progress, showing indecision, or a series of failed attempts to push higher after a prolonged descent. When a stock or commodity stopped acting right, failing to respond to bullish news, or retreating sharply on minor negative news, it was a clear signal that the forces of distribution were gaining the upper hand. His approach to exiting a position was often gradual. Just as he scaled into a position, he would typically scale out, distributing his holdings into any remaining demand. This methodical unloading avoided the psychological pressure of trying to hit an exact peak and allowed him to maintain control over his exit. It also prevented the impulsive, often panicked, selling that characterizes the crowd, which frequently gives back all their paper profits and more when the market turns sharply. Livermore understood that the impulsive exit was just as dangerous as the impulsive entry. Driven by fear, many inexperienced traders would panic sell at the first sign of a downturn, often near the bottom of a correction, locking in unnecessary losses. His disciplined exit strategy, however, was based on objective observation of the market's character change, ensuring that he secured the bulk of his profits before the inevitable transition from mania to panic fully consumed the market. Therefore, step 4 in building a trade the right way is the disciplined art of recognizing when to exit and executing that exit methodically. It requires the mental fortitude to avoid both the greed of holding on for the last point and the fear of selling out prematurely. By systematically unloading a position when the market signals a fundamental change in character, a speculator preserves profits, minimizes risk, and avoids being caught in the devastating transition from market mania to widespread panic, completing the trade cycle successfully. Underlying all of Jesse Livermore's methodical rules for building a trade the right way was a profound, often painfully acquired, understanding of human nature's pitfalls and the absolute necessity of objectivity. He observed, time and again, that the overwhelming majority of speculators lost money not due to a lack of intelligence or access to information, but because their emotions, primarily greed, hope, and fear, blinded them to the market's clear signals. The lessons about systematic position building, while seemingly straightforward, are frequently learned too late because traders refuse or are unable to shed their emotional biases and view the market's actions dispassionately. At various stages of building a trade, emotions become deadly adversaries. Greed tempts one to forego the initial probing bet and jump in with full capital. Hope compels one to average down on losing positions, rather than cutting losses quickly. Pride prevents admitting an initial misjudgment and exiting a trade that is clearly going against one's thesis. Fear causes premature selling of a winning position or, conversely, paralyzes action when a clear entry signal presents itself. Livermore's path to mastery was paved with the recognition and systematic conquering of these powerful internal forces. Livermore himself, despite his genius, admitted to being susceptible to these emotional traps early in his career. His greatest breakthroughs came from the realization that successful speculation demanded an almost ruthless detachment from personal emotions and opinions. The market does not care about your hopes, your fears, or your personal beliefs about where prices should go. It simply moves according to the forces of supply and demand, reflecting the collective action. Therefore, to truly succeed, one must learn to observe the market's behavior objectively, without allowing personal biases or the prevailing sentiment of the crowd to distort their judgment. The inability to disconnect from the crowd's prevailing sentiment is another significant pitfall. When market euphoria is rampant, encouraging reckless buying, it requires immense discipline and independent thought to stand apart and adhere to a methodical position-building strategy. Conversely, during periods of panic, when indiscriminate selling grips the masses, it demands profound courage to hold one's ground or even initiate new positions based on objective analysis. Livermore consistently stressed the importance of trusting your own observations of price and volume, even when they contradicted popular opinion or the pronouncements of experts. Therefore, the profound lesson, often learned at great cost, is that survival and prosperity in the market, especially in building a trade the right way, demand a relentless commitment to objectivity and the eradication of emotional bias. This is not merely an intellectual understanding but a deeply ingrained discipline. By mastering one's emotions, by adhering to a systematic, step-by-step process of position building, and by trusting the market's true language, a speculator gains the clearest vision, protecting their capital and ensuring their longevity in the unforgiving arena of speculation. Subscribe now, leave a like, and write any comment. This way, you'll help more people see and hear this message, and I'll know that my work is not in vain.